Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today, we're going to be going on Twitter, seeing what they're talking about, seeing what information's out there. Obviously, I'm going to interject my financial opinions along with it. Again, if you want to follow me, you can follow me at finding_finance. And you can follow me on the website, finding-value.com, the platinum membership. Use the word discount in the coupon code if you'd like to join our community. So let's just go right into it. I thought this was funny. Had to retweet it. It says Biden says annual inflation is down by nearly 30% since summer. While not technically wrong, it is awfully confusing to do a percent change of a percent change. PCE inflation ran at 5% for the 12 months ending in February, down from 7% from the same period through June. I just thought that was kind of interesting to see that they would comment on a percent change on a percent change. So here is Redfin's homebuyer demand index jumped to its highest level since last May during the week ending March 26th. I know there's a lot of housing bears out there. I'm just showing data. It says nearly half of the homes are selling within 2 weeks, the largest share since June. Looks like price trends are a bit stronger too. So here are the trends. Median asking price is up 1.4% year over year. It is hanging in there. I talked about March of 2023 being a spot where we could potentially start to go negative. We are hanging on, cliffhanger on here, hanging on, and we're still going up on a year over year basis for median asking price. But we're barely hanging on there. We've got active listings of homes for sale. It is greater by 14% year over year. These are the week rolling average of weekly active listings of homes for sale. You can see on a year over year basis, 2023 is up 13.9% over 2022. We are still at really low levels in terms of active listings or inventory. So it's difficult to say that prices cannot go higher. They can go higher even if home sales decline because there's no homes that are really out there to be sold. Coming to Dow Jones to gold ratio quarterly. This one looks pretty interesting. We've got a left shoulder, a head, and a right shoulder that is formed on a Dow Jones to gold ratio. It's also in a declining move with a flag pattern that is declining. So we are most likely going to see a break to the downside and a pretty big move to the downside and a compression of that ratio where gold will outperform the Dow Jones Industrial Average. We've also seen many charts of gold and silver putting in ridiculously large patterns. Monster patterns change lives. I'll just bring that back. They have monster cup and handle patterns. Some of them started in the 1970s. Some started a little over a decade ago. But everything's lining up for a potential outperformance of gold versus a variety of different assets. And that's exactly what gets me interested in an asset, is the outperformance of all other assets. And it's not, I want to be invested in assets that historically have some sort of pedigree. All right. I know Bitcoin's new and Bitcoin has outperformed a lot of other assets, especially over the past decade plus. So, but that is one that just doesn't have the history. I don't know the entire way that thing moves in these markets. And I wouldn't even consider it an asset. I'll say that. Anyone looking for signs inflation is abating doesn't understand inflation. After years of creating inflation with QE, the long overdue effects on consumer prices have barely started. Prices have a long way to rise to catch up to past QE, let alone present and future QE. I think one of the things that you can say here is there was a bunch of inflation that was created that got stuck over in stocks and bonds. We can see that in the ratios quite clearly. There's a large divergence of how money has flowed under certain market conditions and the creation of that money chasing those assets. Now, when that all goes and unwinds and rotates differently, all of that money is going to move different under the market conditions that we are in today. That money that's in the system and exists that was stuck over in financial assets will get yanked out of financial assets and placed in other assets in the future, given those market conditions. So when that happens, we're going to see a gigantic rotation of money from financial assets to what I think are hard assets. And it's going to happen under the conditions of inflation. That market rotation of money will also create more inflation because money is going to be chasing a lot fewer, a lot smaller sectors. So we've got gigantic money chasing a lot fewer physical items in the real world, driving prices higher. And driving prices higher is also going to be a feedback loop of higher inflation. It says bank run in slow motion continues. Deposits at U.S. banks fell sharply for a second week. Deposits at commercial banks dropped by 125 bill in week ended March 22, marking ninth straight period of declines, highlighting preference for high-yielding money market funds. And we can see this decline here of U.S. bank deposits dropping for a second week. We've got SRS Rocker report. We have one even better. Can't produce metals without oil. The global oil industry is now only replacing 1 barrel of the 5 barrels it consumes each year. Welcome to the energy cliff. This is why I cannot get my eyes off of oil here. We are consuming more oil than what we are finding. Approximately 5 barrels to each 1 barrel that we're finding. So we're consuming 5, finding 1. This is our global oil discoveries over time. The global oil discoveries is in the silver light color. Net global oil production is in the gold color. And you can see this ratio as we look going from left to right. And we were finding more than what we were consuming in the 1970s by plus 248. That is also where we hit peak oil in the United States temporarily. Then we went into 1980, 90s, 2000s, 2010s, and then 2020s as the estimate. And you can see there's a gigantic lopsided effect where our net global oil production is vastly outperforming or out-consuming, I should say, our global oil discoveries. That is going to manifest itself in a gigantic problem in the future. And it's going to come up on us very quickly out of the blue, and everyone's going to say, what the heck just happened? Prices, I think, is going to go very much vertical. And what I try to think of and what I try to do is I try to take a long-term picture and say, can we even double the oil production that we have today? I don't think there's a chance in heck that we could do that. And in order to double GDP, if we had to double our oil consumption, if for a doubling, you're looking at maybe like 14 years, 10 years or something like that. I don't think we can go another 10 years with oil prices just going up out of control to some degree. I know a lot of people say what they'll say is, oh, we just need more investment. Yes and no. At some point we're going to hit physical, I think, limitations of how fast we can flow oil. Lower grades, what people will say is lower grades and lower reserves require higher prices of oil. But higher prices of oil does not mean that you can physically flow it as fast as something that's a liquid that you're yanking out of the ground as a liquid. You're not mining this stuff out of the ground. So it's going to be a very interesting future. And I do think that there's the potential, even with higher prices and higher capital investments, that the flow rates of oil will not be equivalent to 102 million barrels, 103 million barrels, or whatever we peak out at, 110. That is one thing that does concern me. And this here is the backing of all future growth of the stock market is energy. Energy is the future growth of all currencies and all stocks in the world. This is where the choke point is, in my opinion. The most lucrative spot to be looking. Josh says, buy small cap oil and gas stocks. You can see PSCE is the small cap little guy here. Here, let me go back. Small cap down here, and we can see that it's underperforming the other ones. And these are also vastly underperforming the S&P 500. This is all going to change, I think. We're going to see a outperformance of energy-related sectors massively. I'm in the camp. I kind of like the small mid-cap guys. I don't like the small cap yet, but the small mid-cap, I think they can get loans. I think they are large enough to generate their own cash flows and self-fund a lot of stuff. I think they can kind of move on their own, so to speak. Here's Tavi. He says, after 3 years of price increases in commodities, one would expect the overall supply of natural resources to be materially higher. That couldn't be further from the truth. The tightening of monetary conditions has made access to capital incredibly challenging. In fact, aggregate capex for commodity producers remain historically depressed. Government policies and ESG mandates have also played a role in adding another level of complexity to the development of new resource projects. The combination of these factors supports the long-term case for commodities and why inflation could be structurally higher for the next years. Keep in mind that this asset class remains underallocated across most institutional investors. A great rotation is upon us, and this commodities cycle is likely only getting started. This is the commodities equal weighted index. You can see that we've had a massive run higher here. This is our wave one. Here's our wave two pullback. And is this pullback done where we're going to head higher? Or do we have a further pullback here, one last kind of washout, where we get kind of, let's say, an A, B, C correction? I think there might be one last possible washout. Hard to say. I'm not betting any sort of money on that. I'm riding long, staying long, am long, because of the market fundamentals, where we are in this market, which is super early. And I just don't see the risk reward of trying to time this stuff in the short term. I just think it's going to mess me all up. So what I've done is I've stayed long. I'm going to stay long. And if we get a little bit of a further pullback, hopefully I've got the smarts to load up even more in my favorite companies. So coming on down, we've got any supporting charts for the supply side or tightness of financing? What he posted here says aggregate capex for energy companies adjusted for GDP levels is still below every other depressed level in the last 30 plus years. Current levels are over 75% lower than the prior peak. This is capex for energy companies, just way down there. That is crazy. And that's that ABC correction. And then this is your kind of valley of despair. This is your double bottom, so to speak, triple bottom, I guess. And this kind of goes down. It's almost like this gigantic speculative chart where you peak. This is your double top. Sometimes this is located down here. This is your double top. It comes on down. This here is like to the T, a speculative bubble chart to the T here. Kind of crazy. So, coming on back. I posted here, it says, they say lumber looks bad. Yearly chart looks different. Retest for a much larger move. I know this is probably not a popular topic, but we've got a lot of consolidation that happened on top of this guy on a yearly chart. So we hit our head, hit it a couple times through here, hit it through here. We were on it, and we're coming back and doing a retest. Is this going to launch higher, or are we going to head lower? A lot of people look at employment. They look at pay increases for the median pay and all that stuff. If we get a large rotation out of bonds of money, that money cannot be absorbed out of stocks and bonds into physical assets, guys. It just can't. So what you're going to see people who are very wealthy trying to protect wealth. They may yank money out and start buying homes with it because they have nothing else to buy. Just an FYI. That's kind of my opinions on it, because we haven't seen a rotation out of bonds and stocks like the 1970s in a very long time. And if we get something like that, maybe this is indicating that we are at a low right now, and that more inflation is potentially coming. And that inflation is going to have an impact on bonds and stocks and how money rotates in the system. I've talked about monster patterns for monster moves. Looks big to me. Oil, gold, silver, commodities look great long term. Anyone else thirsty? Grab yourself a cup. We've got some cup and handle patterns. We got some flag patterns. This is crude oil with a massive flag pattern. This consolidation was from 2008 all the way to 2020, and this is the pull on it. Could this be a gigantic move to the upside with this retest that we are potentially finishing and starting to bounce off of right now? It very well could be. We've got massive cup and handle patterns in gold. There's your cup and handle. I've talked about this before. We're breaking to the upside for gold. We want to break out of 20. We want to get above 2080 for a price per ounce. And then silver's got a massive one. This is on a yearly candlestick basis. This was the 60s and 1970s move, coming all the way down for a cup and then a handle pattern that we could potentially break. And that line, or that cup line, is at $31.50 if we can break that. It's actually not that much further ahead of us. So that is also pretty cool. I said liquidity is coming to the markets, melt up maybe, something like that. We've got a move in the NASDAQ going on higher here. It looks pretty strong, actually. We also see gold's moving to the upside. There's that break of that flag pattern, or the handle, and that gigantic cup and handle pattern. We've broken to the upside. We have two small little sell-off weeks, but this could easily move on up. And then we've got silver that's been rocketing higher. We're seeing crude oil move higher. We're seeing a bunch of these assets move higher all in tandem together. Is it liquidity driven? Is liquidity coming into the market, and will more liquidity come back into the market? Good questions. XAU to gold ratio chart remains intact, or on track. I was going to say intact. Shoulder, head, shoulder. And you can see the nice little rounded cup bottom there. We're also coming in a falling wedge. We're very close to a breakout in this, where gold and silver mining companies could outperform gold itself. I'm definitely watching this. I think we could see a big move in gold and silver mining companies coming up. And if we break this, it's only going to make me more bullish. I'm going to be monster bullish when that thing breaks, although I'm basically already there. Reminder for Platinum members, we have a call tomorrow at 7 a.m. See you guys there that are part of the community. We've got here, demand is soaring, but global mining is not expanding. Near universal agreement that in the coming decades, demand for metals and minerals will boom. So this is the global mining underinvestments in growth. These are your years on the bottom. Now, the thing that scares me here, guys, we've got cost curves that are increasing. And I think that's why people are underinvesting in growth of global mining. The cost to produce, the cost to develop these mines is increasing quite substantially. And the price of the commodities are too low. So I think the easiest way to play this is to look for the physical commodities themselves, because they have to go higher in order to turn this on. It has to go higher for the physical commodity price. Now, if you're in a mining company or a developer, their costs are going to go up with the development of that mine. And if inflation still persists, the miners may or may not have their costs under control. The commodities themselves will go higher if the cost curves go higher, because it's going to force the price of the commodity itself higher if your cost of mining continues to increase. There is a setup where some of these mines get somewhat built, or they get denied, or they get rejected because countries don't want them to be built, or certain tribes don't want things put in place, or countries nationalize or tax the living junk out of it. And the commodity price continues to go up, while your mining stock does not go up. It actually goes down, or they lose the asset in its entirety. So the risks are increasing with time, I think. And I think that the risks to the physical metals and the rewards are getting better for the physical metals. The physical metals risk-reward profile is getting better and better and better with time. Now, here's John Wake. He makes this comment He says US has the third lowest percentage of households that own their homes free and clear without mortgages. He said he finally wrote a piece in it. I didn't go in there and read this study, but I just wanted to make a comment. A lot of other places in the world do not have 30-year fixed rate loans. It forces them to pay the house off quicker. So even though we might be the third lowest percent of households that own their homes free and clear, I've got a mortgage. I could pay my house off free and clear already, but I don't because it's at 2.75% and the inflation rate is far greater than that. By year, whenever this thing comes due, it's 20 years out from now, my mortgage payment is going to be less than a meal for lunch. That's like what it's going to end up being. So to pay it off, I'm basically taking today's dollars and paying the bank more money today if I were to pay it all off than I would be not paying it off and having the future purchasing power get sucked out of that currency and giving the bank back worthless dollars. That's what I'm going to do at least. Says this is Tavi again, the recent banking problems reminded us of how the US economy is facing a trifecta of macro imbalances: the debt problem of the 1940s, the speculative environment of the late 1990s, and the inflationary issues of the 1970s. Never in history have we had all three of these issues happening at once. When financial problems reemerge, the Fed must always resort to financial repression, letting inflation run hotter than historical standards. Debt, valuation, and inflation. This is US debt to government GDP, 98%. Way up there, just like the 1940s. We've got S&P 500 cyclically adjusted price to earnings ratio, 99%, way up there, just like the 1999-2000s. US Consumer Price Index year-over-year change, 88%. We're up there just like the 1970s, just like the 1940s, and it's probably going to remain elevated. Just like he said, they're going to need to deflate this debt with inflatione. We've got silver drilling highlights here, silver intercepts. I just retweeted this. Go Gold Resources. Nice 2,153 grams per ton there. That's pretty awesome. Abra Silver, Aya Gold and Silver, New Pacific Metals, Vizsla Silver, and some of these other exploration companies with some very good, solid findings. Good for them. Michael Lynch, JP Morgan sells 33 tons of gold on the first day of the April contract. That is the largest COMEX sale in their history. A routine trade for defending the cabal's fiat. I do think that's what's going on. They're probably dumping their pants right now. That's where I'm going to end it, guys. So that's what we've got for today. Hopefully you guys enjoyed the content. Give me a thumbs up. This is being released. We're having our platinum question and answer session right now. We started it at 7 a.m. Mountain Standard Time. Hopefully, if you guys are members, you don't forget. Definitely, sign in, jump on the call if you haven't, and love to see you guys there. But that's all I've got, guys. Become a subscriber of the website and the channel. I'd love to have you at either one, and we'll catch you next time. This is Finding Value.